Hello and welcome to this Mutual Fund Corner special. I'm Pavitra Parekh and today we're going to be discussing index funds. We get a lot of questions about this, the case for investing in them. Does it make sense in the current setup as well where, markets are likely to be range bound? At least that's the kind of view that we have been getting and, how you should go about it, how much money you should put in. So we have a special guest joining us. Prableen Bajpai joins us from FinFix Research. Prableen, thanks a lot as always for taking out the time and speaking to us. My first question is exactly on this, that take us through the advantages that you see for an index fund and at a time when the markets are likely to be range bound, do you still think this is a good fund to get into? Of course, we always talk about the fact that you should get in with a longer term horizon, and in that case, it doesn't matter what the returns maybe just for this year would look like. But your take on this?
Okay, hi Pavitra, great to be here. I think I'll touch on the returns part first. So for the last 1 year, if we see, actually Nifty has just delivered about 2.5–3% returns. And even 1 year SIP returns are just about 4.3%. So I think 2023 can also be slightly, disappointing in terms of, I don't think we're gonna, market can be, like you're saying, range bound. And from expectations point of view, I think the expectations have to be set right. Because even a 2 year SIP as of now for Nifty 50 is just about 6% returns. And these are the times when investors actually need to understand that equity is for the longer time period. Now coming to the part where, Pavitra, whether, a passive strategy should be taken and what are the benefits of it, I think approach like what we have, just going and buying the index is just very simple to understand. So for investors, I think it's more convincing to see their funds sort of replicate the market. And I think especially as a beginner, that, this is the reason why probably the fund is not moving, because the markets aren't really moving either way. This fund selection, the whole process where we are somewhere looking at the best performers, I think that chase is given a break. So we don't need to worry about whether we are picking the best or the worst performer from the category. We know whatever the market will give, we have to accept the market returns as well as the market risk. And it involves no human intervention. There is no emotion or any sort of a bias available, no room for that actually. So in nutshell, I think as a mature market, India will eventually move to a point where passives would gain traction. As of now, I think it will be a combination of active and passive in India.
All right, got it. Do you see some drawbacks as well for this kind of investing? Of course, you mentioned the kind of returns, but this is when you look at it on, like a shorter term kind of horizon. So take us through the kind of drawbacks that you see over here, and who do you think this kind of fund is best suited for? You did mention beginners briefly. So do you think this is perhaps a good first investment to make?
I think drawbacks, Pavitra, not too many, but yeah, things that investors should be knowing. I think the first is that all the popular indices, whether it is India or the US, are market cap based. If we pick S&P 500, it's a market cap based index. In India, we pick Sensex or we pick Nifty 50. All of them are constituted in a way where as the market capitalization of a company becomes bigger, it is included in the index. And this sometimes does result in companies being excluded when they aren't doing too well. For example, Tata Steel was excluded from the index, and after it gained 72%, it was again included back in June 2021. So it was after a gap of 6 months. We've seen Tesla, it was included in S&P 500 after it had run up 600%. So somewhere market cap based indices are looking at, the company's share prices going higher, and that increases their market cap. And this at times overlooks the governance part, something that we've seen even in case of Adani stocks or Satyam. That was also part of index at some point. So I think that's a bit of a thing which investors should be aware of, but it can again happen even in the active strategies. Second mild thing I think which investors should be careful about is the over concentration, because as a market cap based index, the top holdings get a higher weightage. So that's something they should remember. Of course, so it's not going to buy any undervalued stocks. So value approach is ignored. So when they're constituting their portfolio, they need to be sure about that they're adding something from, the value part as well. And I think the fourth bit of a concern here is that there is never a protection on the downside. When you're buying the market, you're buying the risk return, the overall market.
Yeah.
So there is no scope for cash holdings. And that definitely doesn't give any downside protection.
Okay, I think those are important points to highlight. Prableen, another question is that every AMC will offer you an index fund, right? You can go to any fund house and you will get an index fund. So we get asked this a lot, is that how do you pick? Do you look at the AUM? Do you look at the tracking error? What are the things to look at when you have to pick one index fund over another? Or does it not matter too much?
Everybody's actually coming up with their passive strategies.
Yeah.
So it's just becoming more and more cluttered, the whole space. I think a couple of things which investors can bear in mind. I think understanding the composition of the index, the style of the index, are they going in for a market cap based strategy? Is it an equal weighted strategy? That has to be seen. Then the overlap between indices themselves, Pavitra. For example, if I pick Nifty 50 and I go and pick Nifty 500 also, there will be an overlap of the top holdings. So I think that's something investors need to be careful about. Third, I think how it fits into the overall portfolio. Be it an active strategy or passive, these are just mediums and styles of investing. Ultimately, it is the suitability of the product from the point of view of your overall portfolio. And because we are looking at different AMCs, I think how they can probably decide between the AMCs is how they have been managing the past, let's say, experience that they have with passives, and also the tracking errors over 3 to 5 years. Some indices strategies are not that old, but whatever time period they have, I think tracking error is again something which they can see, but cannot be just one deciding factor. All of these combined together.
Would you look at the expense ratio as well? How important do you think that is when you're looking at an index fund, or should you not concern yourself with that too much? Because the difference is not really that high, right?
So I think between, if we look at all the expense ratios across different passive strategies, it's between, for direct plans, it's between 0.06% to about 0.19%, Pavitra, what I had last checked. And I think between them, this is a factor which can be, which is a variable. It's not a fixed component. So it's not that a fund today which has a lesser expense ratio cannot change its expense ratio. So I think your expense ratio cannot be the whole and sole criteria. Sometimes it's also a marketing strategy, coming out with, let's say, the lowest cost ETF or lowest cost index fund. I think one has to look beyond the expense ratio, because in general, passive strategies are not very expensive.
Okay, that point is taken. Just one final question. How do you pick, if you have to, between an index fund or an ETF, right? Because this is also something we get questions on all the time. So would you suggest an index fund over an ETF or the other way around?
I think two deciding factors here. If you already have a DMAT and you're used to using a DMAT account and you're paying the brokerage, you can go in for an ETF. But the real utility of an ETF is, Pavitra, when you're actually buying and selling during the trading hours, because an ETF enables you to do that. I think other than that, majority retail investors, I think they'll be fine with an index fund, because more flexibility in terms of, initiating a SIP, STP. And I think so index fund also works quite well for retail investors.
All right, that makes it absolutely clear. Prableen, thanks a lot for joining us and taking us through the basics of getting into index funds, what the pros are, what some of the risks perhaps are of this category as well. We'll wind down on this edition, but I hope this helps any new investor that's looking at this category of funds.